Chapter 7 discusses cash and cash receivables. We'll start our discussion with cash. Cash on the balance sheet can be shown as cash and cash equivalents. Cash is amounts readily available to pay off debt or to use in operations. Examples are currency, coins, balances in checking accounts, etc. Or cash equivalents, which are short-term, highly liquid investments that are convertible to cash with little risk of loss. These typically have a maturity date no longer than 3 months, and a company will define what it considers cash and cash equivalents within its notes to the financial statements. Examples include money market funds, treasury bills, and commercial paper. When talking about cash, it's important to consider internal controls. Remember, cash is the most liquid asset that a company has. Therefore, it's susceptible to theft. Effective internal controls encourage discussion on adherence to company policies and procedures, promotion of operational efficiency, minimization of errors and theft, and reliability and accuracy of accounting data. And when we consider internal controls from a financial accounting perspective, our focus is primarily on these two components. Some of the main titles of Sarbanes-Oxley dealt heavily with internal control, particularly Section 404, which required a company to document and assess its own internal controls, as well as to have auditors express an opinion on internal controls. One of the most authoritative bodies we have in accounting area on internal controls is COSO, or the Committee of Sponsoring Organizations, which put together a definition of internal controls, indicating that it's a process designed to provide reasonable assurance regarding the achievement of objectives in 3 areas: effectiveness and efficiency of operations, reliability of financial reporting, and compliance with applicable laws and regulations. When considering internal controls as it relates to cash, remember that cash flows 2 directions. Cash comes in as cash receipts and cash goes out as cash disbursements. We have to consider both directions in which cash flows when considering internal controls. Let's start with cash receipts. Remember, whether we're talking about cash receipts or cash disbursements, one important aspect of internal controls as it relates to cash is separation of duties. Separation of duties is where we separate related responsibilities from individuals. For instance, individuals that have physical responsibility for assets like cash should not also have access to the accounting records. To do so would open up an opportunity for them to both steal cash as well as hide the fact that they stole cash. Let's look at how a separation of duties might play out in the cash receipts process. For instance, if we establish internal control using 3 different employees, we could say employee A opens up mail each day and prepares a multi-copy listing of all the checks received. Step 2 would be a different employee, employee B, takes the checks along with 1 copy of the listing to the person responsible for depositing the checks in the company's bank account. Step 3 would be a second copy of the check listing is sent to the accounting department where employee C enters in the cash receipts to the accounting records. Notice what happens. We have one employee here that actually opens up the mail and documents what checks have been received. They create a listing, and then a second employee then takes those checks and deposits them with a listing to ensure that all the checks that have been received were actually deposited. The third individual actually updates the accounting records to show that the customers that owed them money actually paid. And notice what this does. This says, for instance, if employee A decided to take one of the checks and put it in their pocket and then endorse it in the back with maybe a standard sort of stamp or something that the company might have and try to deposit that check, remember that employee number 3 has access to the accounting records where employee number 1 doesn't. So what's going to happen is customers that owe the company money are going to go long outstanding times without paying. And employee number 3 is going to start to ask the question, why are we not receiving cash from these customers that owe us? What's more is they're probably going to create notices and continue to send them to the customer to say, hey, you owe us money and you're not paying us. And so what that causes the customer to do is say, hey, we've already paid you. And then we go back to employee number 1 and say, hey, did the check come in? And that way we can create a situation where it's much, much harder to actually steal money than it would be if these related responsibilities were given to a single person. On the flip side, when cash is flowing out, we have cash disbursements. These are payments made to our vendors or our suppliers, the people that provide us goods or services. Here, the objective is to prevent unauthorized payments and to ensure that disbursements are properly recorded. To do this, one of the things that we require is that all checks should be signed by only authorized personnel. And what's more is we typically require that to be signed by more than one person if the check is above a certain material threshold. And what that material threshold is, it really needs to be defined by the company. It has to be defined in context, but a common one that I've seen in practice is about $5,000. We also often require that all expenditures should be authorized before the check is actually signed. So you might think that the check being signed is when the expenditure is authorized, but typically what happens in practice is that we first authorize even a purchase order to say that we're going to solicit this service or this product from a supplier or vendor. And then we authorize the invoice, what it comes in, to the applicable parties, the managers who receive the service or receive the product, right? They authorize indicating that it's legitimate. And then all of that is combined together in what we might call a voucher packet and then provided to the check signer so that the check signer can say, yes, this is a valid payment, I'll sign it. And then maybe we have a secondary signer also sign the check depending on what the materiality threshold is. And remember, although we would like to use checks in all situations, now checks, maybe physical checks aren't used as frequently as they have been in the past. We still do see them in practice, of course, because they provide documentation, which is great. But this process can be applied to electronic checks, so to speak. So transactions that happen electronically as well, we can apply that same type of process that two people have to approve electronically, or that first we require a voucher packet before we actually pay an electronic disbursement. Restricted cash is cash that is restricted in some way and not available for current use. And so because of that, we don't classify it with cash and cash equivalents. Instead, we're going to report it as a non-current asset, such as investments in funds or other assets. Now, we do want to consider what the purpose is of this restricted cash. If it's a specific purpose that we have, for instance, for a future plant expansion, we would classify it as investments in funds or other assets and classify that as a non-current asset. However, if it's contractually imposed, meaning that, for instance, we might be required because we borrowed money to keep a certain set of money set aside as a restricted cash that we can't spend, then it really considers, we have to consider what the contract is classified as. If the debt, for instance, is classified as non-current, then the restricted cash is non-current. But if the debt is classified as current, then the restricted cash is classified as current. Compensating balances are a common example of this restriction of cash. A compensating balance is an amount that compensates the bank for granting a loan or extending a line of credit. Under this arrangement, the borrower is asked to maintain a specified balance at a low interest or non-interest bearing account at the bank. This balance is typically some sort of percentage of the committed amount of the borrowing. And the borrower, because of this, typically has to pay an effective interest rate that's higher than the actual stated rate because effectively they're not truly borrowing the face value amount. Remember, they're having to take a set amount, typically a percentage of that borrowed amount, and set it aside where they can't spend it, which means the actual loan that they're getting is less, which means that the interest rate that they're paying on the original loan is effectively higher because they're actually borrowing less money than the face value states. Look at a quick example of this. It says a company borrows $10 million from a bank at an interest rate of 12%, so that's the stated rate. The bank requires a compensating balance of $2 million to be held in a non-interest bearing checking account. So essentially what's going on here is we're borrowing $10 million, but we only have the use of $8 million, right? Remember, our interest rate that's stated is based upon the $10 million face value, which means we're paying $1.2 million in interest, but really only getting to borrow $8 million. This essentially gives us an effective interest rate of 15% when we take the $1.2 million in interest and divide by the actual amount that we get to use. Let's take this concept one more time and apply it in a multiple choice question. You can pause here and then we'll come back and solve it together. This problem states that Jenks borrowed $13 million from a bank at a 10% stated interest rate. The bank requires Jenks to maintain $3 million in a compensating balance. What is the effective interest rate? Okay, first thing we need to do is calculate the interest based upon the face value of the loan and the stated interest rate. So multiply that out by 10%. This gives us an amount of interest of $1.3 million. Now we need to consider how much we actually have usage of in the loan amount. We have $13 million as a face value, but we only get usage of $10 million because $3 million has to be kept as a compensating balance. So now we're going to take the 1.3 million and divide that by 10 million. And this will become our effective rate of interest, which is 13%.